lots to talk about. Just put the Gainesville Select in Gainesville, Florida, under contract today. This is a 198 room hotel. Average room size is 350 square feet. What's unique about this property, it has 50,000 square foot convention center / ballroom that we're intending to convert into about 30,000 square feet of self-storage space. So this is going to be our first hotel to multifamily conversion with a self-storage element. Got it under contract for $10.65 million at a 7% cap. We're looking to exit at about $36 million. That would be somewhere around $184,000 per door. Investor returns is going to be somewhere north of 32% IRR with a 3x multiplier on equity. So amazing returns, super amazing location, 1.8 miles away from the University of Florida. Go Gators. So an amazing opportunity for either potentially student housing with a self-storage element. But yeah, and we have about 5 more threatening to go under contract. Just got a executed LOI on the Garnet Inn in Orlando. And we're looking at potentially 3 others in Orlando, 2 in Kissimmee, 1 in Altamont Springs, 2 in Pensacola, and more to come. So let's jump into today's presentation. We have a few hospitality assets we're going to review. Certainly open it up for questions.
Can you go over like how, so the projects that you run, what's the like the team that you have like per project, right? So there is like contractors or GCs that do the work, but kind of like running the show. So I assume you're kind of overseeing it, but you probably don't have enough time to actually manage each individual project. So you have somebody dedicated per project, or you have several people, or you have a resource that oversees multiple projects. Like what does it take to kind of project manage such a through the life cycle of this endeavor?
Sure. So we can talk about the Jacksonville portfolio, because that's 3 hotels that I closed on late last year.
Yep.
So that is 3 hotels. That would be the Zen Living, approximately 124 keys, the Days Inn, 110 keys. Across the street is the America's Best, also approximately 110 keys. So once I identify an opportunity and get it under contract, in tandem, I'm having conversations with general contractors. So I had found a group by the name of the Opus Group in Jacksonville. They're familiar with doing conversions. They had a relationship with an engineer and architect in that market, so they brought forward those 2 parties. And then I, being a syndicator, had aligned myself with Elevate out of Dallas, Texas. So they're in essence the KP sponsor and operator. The property manager is a group called ResProp. So they'll be handling the property management. So to answer your question high level, being a syndicator, each project in essence could potentially have a different operator, different sponsor, different GC, depending on the location of the asset in question, different engineer, different architect, but the concept being the same. So my focus is getting the project under contract and having contractual control. And then I shore up the back end with the potential KP sponsor, capital raiser, boots on the ground, construction management, et cetera, et cetera, et cetera. So the teams per project in theory are somewhat different.
Yeah.
In some cases, we have groups that are design builders, so they may have their engineer and architect on staff, as you will, and can help
Yep.
facilitate the change of use. But in the case of the Jacksonville portfolio, I piece parted the entire project, including leveraging and locating the land use attorney who championed the effort to get the change of use approved prior to closing escrow. So in order to mitigate risk to our investors, we want to make sure that we have the change of use approved prior to closing escrow. That can be a process of anywhere between 3 to 6 months. But once we have that kind of shored up, we typically close escrow about 30 to 45 days thereafterwards, which gives us time to kind of line up a fund manager and or capital raiser, an EMD sponsor in this case. So I outsource literally every piece with the exception of acquisition. So my company, my meaning in life is really identifying, locating, and controlling the asset via putting it under contract. And then I bring in all the necessary parties to make the project a success.
I see. And so like you negotiate basically like which pieces you outsource, you give away
Equity.
equity,
Correct.
you keep some equity through the lifetime of the deal, basically.
Correct. So we typically do like a 70-30 LP to GP split. That's now changing to more of a 60-40 because of the returns are just so generous that we're almost concerned that our investors will not want to invest with us unless we realize a 35% return, so on and so forth. So with that being said, we're kind of changing those splits, but it really is a case-by-case basis depending on who is coming to the table for said project.
And so your role throughout, would you still you consider yourself a GP on the deal?
I am 100%.
Okay. Is there another GP on the deal, or are you the only GP?
Say again?
Would your company be the only GP, or do you partner with other?
There's multiple companies that are partnering and GPing on the deal.
Got it. Okay.
So potentially as many as 5, right? So
the
GP is broken up into like 5 categories. You have your acquisitions, you have your boots on the ground, you have asset management, you have your capital raising, et cetera, et cetera, et cetera. So those are literally divvied up in percentages, and those are kind of handed out based upon their role and what participation they have in the deal.
Got it. Okay.
Cool. Yeah. That's kind of a high level overview, but it literally changes kind of case by case depending on.
I'm just trying to wrap my head around it. Yeah, just
I can certainly share with you on more detail if you're interested in potentially GPing or LPing in one of my future projects.
Sure.
Cool. Let's jump into the presentation. And we're looking at the Super 8 and Travelodge in Kissimmee. These are 2 hotels that are literally side by side. So they're located on West Earlo Bronson Memorial Highway. I think it's like 7475, and the other one's like 7485. So they're literally side by side. So let's go ahead and jump into this particular opportunity. And this is in Kissimmee, Florida, which is a subset of Orlando. So the first one being the Travelodge, opened up in 1990, was built in 83, renovated in 2021, 60 keys, a 1-story hotel, does have some meeting space, not a lot of amenity space, but certainly has a good footprint as far as acreage. It's on 4.5 acres. And I'm able to do a change of use. It is zoned for multifamily. So this is 60 keys and 160 surface parking spaces, which is a 2.67 parking space to room. So, and I believe we have the next one, Christiana, next slide. And this one is literally next door, so 7475, Super 8. Originally built a similar year, 1983, 56 keys, opened up in 2023 as a Super 8, is franchised, has 160 spaces, so the same ratio of parking space to room, and also on the same type acreage. at 4.5 acres. And I believe, if my memory serves me correct, the seller is asking for around 9.5 for both properties. Next slide. Here are some pictures. So the Travelodge does have a pool, tile floors in the rooms. Looks like it's been recently painted. Doors have been updated. Those P-tacks look like they've been recently replaced. So hotel is in decent shape. Next slide. And then here's the Super 8, similar makeup. Room's a little small in size, which becomes a little bit challenging as far as getting conventional debt on these assets. We typically like to see around 350 square feet. And I believe these are kind of closer to 280. I don't see sprinklers, so that would be an additional cost. But very similar makeup as the previous hotel. Next slide. And let's check out the location. So Super 8 and Travelodge, kind of side by side one another, located along the 192, has great presence. I see a Disney gift outlet shop, and we see some residential, or at least some high density residential on the backside. That looks like multifamily on the top of the picture. Next slide. Let's check out the analytics. So here is why I love Florida. You're not going to see this pretty much anywhere else in the country. We have a 12-month absorption of 1,905 doors on an annual basis. And if you look at the population growth of around 14%, this really kind of speaks volumes. Florida is growing between 1,200 and 1,500 persons per day. We see an exit price of $282,000 per door with a cap rate of 4.8%. Rents are strong, and we see a number of units under construction. So yeah, great opportunity here. Analytics are super strong. Let's go ahead and take a look at the next slide. Rent comparables. So you can see we can potentially rent a studio apartment for around $1,100, if not a little bit more. We're pushing around $3.20 per square foot. Next slide. Let's take a look at the underwriting. So this is with a purchase price of $6 million. Seller's asking for 9.5. We're probably going to relook at this and see if we can potentially, meet somewhere in the middle. Christina, can we set up an underwriting session so we can dive into this a little deeper and see if we can maybe
Yes.
potentially up the price some? But
Okay.
yeah, we submitted an LOI. I typically like to kind of start on the lower end just to kind of feel out the seller, kind of check motivation. As you can see, the exit price per door at $182,000 is really light compared to what we saw early in those analytics. So certainly some room there for us to potentially bump our purchase price up some. And it has lots of acreage where we could potentially add some additional amenities, if not some self-storage elements. So Christina, can we get Nick to join this call when we do this underwriting session? And let's see if we can add a self-storage element to these properties to, bolster up the NOI and potentially get us to a higher strike price.
All right.
Yeah, I can see, with the amount of parking space that's available, the amount of acreage between the two properties, there is a high potential to add a kind of a self-storage element to these properties. So I think we should probably look at re-looking at this underwriting and maybe adding a self-storage element to this. Any questions on these two hotels? I'll keep you guys up to date on how this develops. I have a feeling we'll pick these two up for a great price, but certainly want to start low and figure out the seller's motivation. with interest rates being at a 20-year all-time high, I think we're going to see a lot more hospitality assets coming across my desk. So more to come. And let's go ahead and jump into the next property. All right, so changing states, going out to Cincinnati, Ohio. This is the Quality Inn Conference Center. Again, hospitality multifamily conversion. Next slide. Property summary. Large asset with over 200 keys. It's a 6-story interior corridor hospitality asset with nearly 10,000 square feet of meeting space. Originally opened in 1969. We do have a 2-to-1 ratio on parking, which I like to see. Nearly on 7 acres and zoned for mixed use, so we could certainly convert this into multifamily. Nice looking asset in question. Looks like the owners have taken well care of this property, being that fact that it was built in 1969. So roofs look like they've been recently done, recently painted on the exterior. Asphalt looks like it's in good condition. Not familiar with the Sharonville Blue Ash submarket, but let's go ahead and dive into this a little deeper. Next slide.
Can I ask a rookie question on that, on just general?
Yeah, no, this is
very noob question. But so when you find these properties and you see the zonings for mixed use, is that typically like is that common? The person who owns this this hotel, they know that it's zoned like that and it's like more marketable that way, or like how do you figure out that information when you're sourcing deals?
Yeah, so what I typically do is I have CoStar access, and with CoStar I can get the zoning information, and then from there I'll typically have my assistant reach out to the city and have a conversation to kind of gauge their temperature as far as their interest in doing a change of use. I'm sure you're well aware of this, but there is a housing shortage nationwide, not just in Cincinnati, but pretty much everywhere you go. And so I think that there's going to be a big push for these types of conversions. Governor DeSantis just recently passed a bill to kind of cut the red tape to allow more of these conversions. And I think you're going to see more of that happening nationwide. There are situations where the city is not as converter or conversion friendly, depending on where the asset sits. You know, it could be potentially next to like an industrial zone. They may not feel like it's a good fit for their master plan for their community, but it's a case by case basis. Most importantly, when I submit a letter of intent, I ensure that I have contingencies built in. And one of the most important contingencies would be the rezoning and or change of use. Certainly don't want to close escrow on a hospitality asset and operate as such. So we ensure that we have that built in. Typically, when I'm talking to brokers and or hoteliers, when having the conversation about their property in question and they're looking to sell, if it's something built, you know, pre-1990, their highest and best buyer is going to be a converter. So more than likely, they're seeing a decline in reservations, they're seeing a decline in NOI, and in order for them to maximize their return as far as selling the property, you know, only converters like myself are willing to pay top dollar, because in most cases we're buying somewhere near, you know, 30 cents on the dollar for the hospitality asset. And then once we're able to convert to multifamily, it's going to be worth somewhere around 3 to 4 times more than what we paid for.
Okay, got it. And so just on the DeSantis note, like, do you see that favor towards the rezoning is like more favorable in red states, or like you said, it just depends?
Well, I typically look at red states because they're more landlord friendly, right? You know, being in California and being licensed here in California, I do residential, I do fix and flips, I do creative financing on residential, but I don't have a large retail or rental portfolio, only because it's just challenging to get, people that do not pay their rent on time out, whereas it's just the opposite in red states. So I'm bullish in states like Tennessee, the Carolinas, Florida, Texas, Arizona for those reasons.
All right, thank you.
My pleasure. Great questions. Feel free to chime in with those questions. The purpose of this call is to educate, incentivize, partner. I'm always looking to help others learn, whether we, work together an opportunity, if it's just me simply underwriting an opportunity and or potentially partnering. That's the purpose really of these calls, is to kind of network virtually. And, I love giving back. So feel free to ask, any question, anytime. Next slide. So here are some pictures of the asset in question. It's a handsome property, has, great kind of look and feel, certainly has lots of amenity space, lots of parking, lots of potential. I'm not sure if you're aware of this, but Cincinnati is definitely a growing market. We're seeing a lot of multifamily operators and sponsors and investors look closer at the Cincinnati market. So something to certainly consider. Next slide. So kind of a 10,000-foot overview of the property in question. As you can see, and this is one of the reasons why I love conversions, especially hospitality to multifamily. In most cases, you're going to find hotels that are strategically placed next to large arteries when it comes to freeways. And you can see this is no exception. So along the 71 on Pfeiffer Road, certainly has great presence. We see some residential and some high density residential kind of on the south side of the property. You got a financial center located towards the right side of this picture. So, it looks like it's in a great location altogether. We see kind of a fitness facility, looks like off to the left. I see those look like tennis courts in the bottom left-hand corner. So great look and feel, and certainly something to consider when looking at doing conversions. You want to ensure that you have amenities such as fast casual dining, fitness centers, financial services, medical centers, universities, all of which will help your absorption rate, as well as, most importantly, your population growth. Some cities will have a declining population growth. An example of that would be like San Francisco. If you look at the analytics in San Francisco, their absorption rate for units for multifamily is a negative number. It's a negative 311. So there are more people exiting or leaving the city than actually moving to. Doesn't necessarily mean that I wouldn't invest in San Francisco, but the strike price or the cost basis would have to be extremely low to kind of offset the potential risk there. Next slide. Here are the analytics. So as you can see here, the absorption rate is not really exciting. It looks like it's a negative 33. Population growth is a little light. So in the submarkets of 4.8%, in the actual particular property, it's a 0.8%, which leads me to believe that this hotel could be in a more of a light industrial area where there's not a lot of multifamily, which could potentially explain why the absorption is at a negative number. So depending on the opportunity, it may motivate me to call and actually talk to some properties in that area to figure out whether or not there's a waiting list for any of their multifamily units. But another thing that kind of concerns me is the exit price per door at $139,000. That would mean I'd have to buy this hotel somewhere around $30,000 a key, which would probably be my ceiling. So with that being said, your soft and hard costs as well as your purchase price, you know, you want to be in somewhere under, say, $70,000 to $80,000, and I'm not sure that's achievable. Also, if you look at the rents, you'll see that the studios are renting for around $719. In more cases than not, that studio is probably somewhere closer to a 400 to 500 square foot size apartment. And our hotel rooms are going to be 20 to 30% smaller, which means the asking rent is going to be 20 to 30% lighter. And I typically like to see numbers somewhere north of $900 for a studio, in order to pencil and offset the CapEx for the conversion. In most cases, when you're doing a conversion on a hotel room, if everything is turnkey and you're just adding a kitchenette, that's going to cost you somewhere in the neighborhood of about a $15,000 cost per door. If you're touching the floors, doing paint, replacing the P-tack, now you're starting to creep to around $20,000 to $25,000 a door, which means the studio rents are going to have to be closer to $900 to $1,000 per in order to offset the heavy lift to do the conversion. Does that make sense? Again, this is kind of like what I call back of the napkin underwriting. And these key metrics or analytics is what I typically will start with prior to actually doing an in-depth dive and doing an underwriting session. And so a typical underwriting session can take anywhere between an hour to an hour and a half, depending on how much data you have to pull from. So with a back of the napkin underwriting session, that could take literally seconds, if not minutes, where you can literally glance at these key metrics and see if this is something worth pursuing. And typically, when looking at these opportunities, first and foremost, you know, when it comes to real estate, it's location, location, location. So you want to make sure that your population growth and your absorption is going to support a conversion. Next slide. Here are the rent comps. And as I mentioned earlier, you can see exactly what I assumed is shored up on this slide. So the third one down is a 500 square foot studio renting for $120 a square foot, which is literally a third of what my target would be for pursuing a conversion. So right off the bat, these rents are a little light for me to want to consider such a heavy lift when looking at a conversion. Next slide. Here's the underwriting. So as you can see, underwriting does not pencil at an asking price of 6.2. As you can see, all the reds indicate these are negative numbers, and hence the reason why it's not worth pursuing. I don't even think it penciled at a $5 million purchase price, because again, the big lift being the fact that we're having to do a conversion somewhere between $20,000 to $30,000 per door. You can't really kind of rent through those numbers as far as the CapEx goes. Next slide. All right, so that sums up, I think, our hospitality presentation. And Mr. Johnson, how you doing, Danny? You're on mute.
I'm doing good. How's everybody doing?
I'm doing fabulous. Missed you at Lifetime this morning.
Yeah, at the W2 today. Grinding
Oh,
away.
shoot. Yeah, holding down the W2.
Yeah, keeping
I
things.
remember what that was like about 4 years ago when I was, carrying a W2.
Yeah.
Nice.
Show up every day at 7 a.m. You know how it is. So
I know how it is, man. Living the
I
dream.
did see your video though too today. So great job with that.
Oh, thanks, brother.
Yeah.
So Dan's going to talk about our upcoming project. I firmly believe in manifestation, and we are diving into office to multifamily. I believe that this is going to be the big play in commercial real estate. So get on board or get left behind. What we're seeing nationwide is the occupancy on office complexes in general are dropping off tremendously. and they're falling off quicker than sellers can actually refinance. And so you're going to see a lot of institutional property owners across the board looking for ways to liquidate. In most cases, these owners are bleeding tens of thousands of dollars, not per month, but probably per week. And so we are bullish on office to multifamily. Now, we're taking a bit of a different approach on these conversions, largely due because we're dealing with so much square footage that sometimes multifamily is not going to get the job done. So we're looking kind of more or less at a mixed use approach. So it's going to be a combination of hospitality, whether that's short-term rentals, or if we potentially obtain a flag and bring in a potential Marriott to the opportunity, as well as a self-storage play, retail, and some office. So I see office space being almost like an Airbnb model where you can actually rent a house or a condo for the day. I see the potential for renting office space, not by the year, not by the month, but literally by the hour. So if you are an entrepreneur, you have a business and you're working with vendors, suddenly these vendors want to meet with you. Probably not a good idea to invite them to your home and have a meeting in your kitchen. More than likely, going to a Starbucks would be, an alternative. But depending on the nature of that meeting, you're going to see a need for office space, conference rooms, and such. And so I see literally doing kind of an automated office space rental by the hour, where everything is literally hands-free. You get a code, you get access to an actual room, you use a keypad to get in said room. That keypad code there that's given to you becomes wiped out or eliminated at the end of said meeting, and it's simply just going to be a rinse and repeat from there. So Dan's heading up our office to multifamily or mixed use conversions, and he's going to be speaking on these meetings on Thursdays and kind of talking about some of these assets that we're looking at. And Dan, you have the floor.
All right.
Can I ask a question really quick before you get started, Dan? Sorry.
Yeah, no worries. Go ahead.
I find this topic like very intriguing, but also like I have no idea what this looks like. I mean, is there like a case study that you've seen where an office has been converted to multifamily and what it looks like pre and post? Because I can't wrap my head around it. I just imagine like, the old brown stucco office that I would never live in, but I don't know what you convert that to make it hospitable. I would love like a visual reference to that.
Yeah, and we do have some case studies that we could leverage, not necessarily something we can pull up on this particular call, but something that we can bring forward in the future. But kind of visualize an office complex, right? So in most cases, an office complex is going to have a fairly large floor plate. And with that being said, your windows and or natural light is going to be on the perimeter of said floor plate. So in order to attract potential tenants, you're going to want to put your apartments and or hotel rooms along the perimeter of that floor plate. And then what you're going to end up with is a lot of dead space in the center. So with that being said, we're looking to convert that dead space into self-storage. And in some cases, we can actually partition out the building by almost eliminating access to that particular asset, whether it be by elevator or stairwell, to whereas if you had a need to rent some self-storage, you could take elevator A to your self-storage floor, put your belongings into said units, and leave the facility. And at that same note, you could have elevator B taking you up to that same floor, which is partitioned off to be only accessible to your actual apartments. And with smart technology, fairly easy to accommodate. But if you can visualize that, that would be in essence the concept. On the ground floors, you would have the ability to leverage retail and office space.
Oh, very interesting. Okay, it makes sense. I can see where you're going with that plan. So. Okay,
Yeah,
thank
some
you.
of-
Continue, please.
Just to add on
Yes,
to some of the buildings that I've seen that have been converted, the apartment units seem to be a little bit longer and skinnier as well. Than just to kind of consolidate them and get more of that, use up kind of some of that dead space in the middle if it's not used for the self-storage.
I see. Okay.
so in
All right.
essence, we're really looking at the asset for its location and the actual box and or structure. And so, we're gonna pretty much gut, each and every floor, and then basically build out the interior walls for either, multifamily, self-storage, retail, and or office.
So does the outside end up, do you renovate the outside such that it looks more like an apartment, or like a more modernized version of like something? Because typically, I mean, at least here in Dallas, they're all the same color, and maybe you go to a specific area of town and the offices are much nicer, but for the most part, they all kind of look a little dated and the same. So do you enhance the outside too?
Excellent question, and one of which we can actually leverage an opportunity that we're currently under LOI for. So if you're in Dallas, I'm not sure if you're familiar with the Ricci Towers. So these are two,
No,
I'm sorry.
I have not heard of those.
Okay, yeah, feel free to Google it, the Ricci Towers, Dallas, Fort Worth. They are two 11-story buildings connected by a 70,000 square foot breezeway. Here we go. So we can kind of jump into this pitch deck a little bit. So here is our pitch deck for this particular project.
Very
So
nice.
look how handsome these buildings are.
Those are nice.
So we currently, the replacement cost on these, on this facility, on this office complex, is north of $180 million. It was on the market for $60 million. We have it under LOI for $25.3 million.
Wow, that's amazing.
So this facility is literally 500,000 square feet of leasable space. So if you do the math, we have this under contract for $51 a square foot. You can't even build residential for $50 a square foot. So residential, say again?
So they're practically giving you this place.
Exactly. So next slide, Christina, we can kind of go through this really quick.
Yeah, I'm in control on here, so.
Yeah, go ahead, Danny.
Yeah.
Walk us through.
Okay, yeah, I mean, you could lead the way if you want. I was just controlling the screen on it as well.
No. I want you to get more experience speaking publicly. You got this,
Okay.
brother. This
All
is
right,
your
yeah.
moment.
So like Stephen explained here, that 25.3 million is what we are currently under LOI at, and that comes out to $51.86 a square foot. We have the renovation costs at $150 a square foot. And that's going to total about $74.1 million. Doing some research at there's quite a wide variety of range as far as what the cost per square foot, being $100 to $250 a square foot, and even in some cases $500 a square foot. But those are even some that were taken globally, some of those numbers. So not all of them are going to be the same at all. This is the total all-in costs on this project are $121.3 million at $249 a square foot. Total equity required is $36.4 million. And then the projected value upon stabilization is $177.4 million, and a value of $56.1 million created with the conversion. This property also has parking structure. It's Currently, it's 50% leased right now, so we're also going to leverage some of those current leases to start producing income on day one when we make the purchase as well, which will help get this project across the finish line as well. Projected IRR on this is 28%, the 2.35 equity multiple, and a pref return of 8%. And the investor capital return is 100% at the end of year 2, and a 6-year hold on the project as well. And here you have an overview of it. It sits across from, it's off of the 35 East, but sits across from a country club that's over out that way next to Love Field as well. It's just about 10 or 15-minute drive to downtown Dallas. There's also the several hospitals there nearby that we're hoping to tap into as far as some of our short-term rentals with traveling nurses, nurses that are coming out for the education. One of the tenants at the property currently is a medical school. So we're hoping to use all those resources to tap into and get some short-term rentals and possibly the hospitality aspect of this conversion project. It's a little bit about us, Stephen, Nick, and myself, and the 3 projects that Stephen currently or mentioned previously. The business plan is to close hopefully in October. You never know how things are going to work out, but we have a site visit scheduled for next couple of weeks here, and hopefully we'll get that a little bit shored up and a little bit more of a firm timeline on that. Looking to have the construction complete at least on 1 tower by July of 2024. Our goal is to take all of the current leases that are in the offices and move them over to 1 building, and then start converting the other tower while we have everything over in the other. That way we're producing income while we're getting all the construction done. Here's a look at the unit mix. What we did is we set up per floor plate. We looked at about a 15% of that space to be used for common areas, hallways, walkways, and then 85% for the units and the self-storage units. What our plan is to kind of incorporate with each unit that you'll get. If you have a studio, you get a 5x10 storage unit with that as well. If you have a 1-bedroom, you get an 8x10, and a 2-bedroom comes with the 10x10, but have different price breakdowns on those. With this setup that we have, it's 391 total units, not including the self-storage. The residential growth, we have it in the market at about 5%. The residential vacancy is a little bit higher, but we also think that's skewed a little bit by it being closer to an industrial area and not as many multifamily to pull from or to pull analytics from. We also pulled the comps on the 4 kind of what we would like to model our units after. Ones that are in the same price range is what we're looking for here. The average on those in the market is $2.83 a square foot for studios, $2.41 for the 1-bedrooms, and $1.99 a square foot for the 2-bedrooms. We also did have 1 property that is kind of the cream of the crop, I guess you could say, of 5-star unit, where they're getting rents at $4.73 a square foot for their studios, $2.80 for the 1-bedrooms, and $3.57 for the 2-bedrooms. So there's a lot of potential there as far as what we could get, depending on what kind of property we upgrade it to. Here's a little bit of overview of all the investments, or the acquisition costs are roughly just under 26 million. Hard costs at 74 million, soft costs at 9, contingency at 4.6, interest and financing at 7.5, for a total of $121.3 million. And then the construction budget. All of the different things, the soft costs that come along with that at just above $9.9 million. And then the CapEx on the property totaling in at $74.2 million. And here's a look at the returns, with the NOIs jumping up from the first year from 5.1 to in year 4, almost 9.3 million. And then we're looking at a 2.5% acquisition fee, 2% asset management fee, and a 3% disposition fee, and a 70-30 LP to GP split. And a little breakdown about lowering the income on the annual depreciation on the property. And just a few other little informations there, and a little bit of timeline with the sale of the property in September of 2029. Yeah, and a little bit of an overview on it with that 30% returns and the 100% of investment back in 2 years, and being tax friendly, and in one of the top destinations in the United States, being Texas and the Dallas area. Yeah, there you go, Stephen. Anything you want to add to that?
No, sweet, great. Thanks for the overview, and let's pull up the Wells Fargo opportunity that we're looking at. Any questions on the Ricci Towers?
Yeah, on Ricci Towers, I actually live like 10-15 minutes from that location. I'm on 35 right now. So how likely is it that I could join you guys in your walkthrough? I mean, I know I'm not part of your team. I don't know if there's any confidential information being shared during that walkthrough, but just the experience of walking it with you guys, I think would I don't know, that's can't really put a price on that. If that's something that can be accommodated, I would love to attend.
Yeah, we are scheduled to be out there on the 10th of August, and we're looking to walk with one of the nation's largest office to multifamily developers. And so that operator sponsor is interested in working with us in our company as well as this particular asset. I would have you reach out to Christina. Christina will put her email address in the chat. We'll have you sign an NDA, and we can simply just introduce you as a junior acquisition manager that had just recently joined my team. So therefore you can kind of be underneath our umbrella when we do the site visit. How's that sound? Is that fair?
Yeah, that sounds amazing.
Sounds like a plan. That's what we do. We make dreams happen.
Yeah, appreciate it. Thank you.
My pleasure. Yeah, Christina will put her, she just put her email address in the chat. Reach out to her, send your contact information over. We'll have you sign an NDA, and then Dan will keep you informed of the date and time of when we're meeting with the GC and the sponsor for this particular project. And if it works with your schedule, we'll meet you out there, and then we'll coordinate with contact information as well. So therefore, you know who to reach out to ensure that you're meeting up with the right group at the right time.
All right, perfect. Thank you so much.
Our pleasure. All right, so we got 11 minutes to kind of round off this meeting. Let's look into this Wells Fargo building in Houston, Texas.
Yeah, here is a picture of the Wells Fargo building in Houston, Texas. A little bit about the property. That's a 3-star office built in 1979, renovated in 1990. It is a little bit on the smaller side of what we look for these properties at 105,000 square feet. Typically what I'm finding is things start to pencil a little bit better once we get up there with the higher numbers. 250,000 is starting to look really good. But we look at anything above 100,000 square feet to see if there is any potential there. The typical floor is 6 stories, and the typical floor is just around 17,000 square feet. It sits on 6.67 acres. It does not say how many parking spots on there, but I believe from what I remember looking at this property, there is ample parking.
I was just going to ask.
Yeah. I want to say typically most offices are somewhere in the neighborhood to 3 to 4 parking spots per square foot or per 1,000 square feet of office space is what I typically seem to find.
That would work.
Here's a look at the analytics. The absorption rate isn't great. It is positive, but it's only at 73. The population growth is kind of stagnant. We have an exit price at 138,000, which is a little bit on the lower side for these conversions. And with this property, you could see the market studios are decent. They're not great, kind of like what Stephen referred to with some of the hospitality to multifamily conversions. we like to see those rents up a little bit higher than that typically. One of the things that is different with this than the hospitality conversions is these are a little bit more, the unit sizes are a little bit more in average with what the market unit sizes are. We're not limited, since we're going in and ripping everything out and creating them new. We're not going to have smaller units. Typically they'll be, we estimate at about 500 square feet for a studio. Right, here's a map overview of the property. It's right off of the 290. It's got a lot of things around it. It kind of looks like it's right on the edge of a residential area as well. But it's got a lot of shopping nearby, Academy Sports, Target, Walmart, Home Depot. So it kind of seems to be good, centrally located location for this property. And here's the unit mix calculator that we use. So what we do is we look at all of the different floors. Like I said earlier, we look at about a 15% unit or 15% for common spaces on each floor above the second story. What our kind of goal and mindset is that on the first floor is where we're going to have all of our amenity space. So on the first floor, we set aside about 40% for amenity spaces, maybe area to eat, maybe some stores or retail shops or something like that, or even just some common spaces where people can congregate. And it also gives us a breakdown of both the how many units we could have on each floor and with the self-storage as well. With this project, we'd use about 78% of the building for the multifamily space. And here's a look at the underwriting, and this does not pencil at all, even at $1 million. I think the biggest influence on this are the low exit prices at only 138,000 a unit, and
Exactly.
14% vacancy rate also doesn't help out very well, and those lower rent numbers as well. And that is it. Any questions from anybody?
No, great job, Dan.
Thank you, sir.
Fantastic. Well, that concludes our presentation for today. We'll be back next Thursday with more properties to review. Feel free to reach out to one of us if you guys have any questions. And I thank everyone for joining today.
All right.
Thank you
Thanks,
guys.
guys. That's good.
Have a great day.
You
Thanks,
too.
bye-bye.
They-
Bye now.